Hey everyone! Are you an Aussie crypto investor wondering how to navigate the complex world of crypto taxes? Do you know about the awesome 50% capital gains tax discount that could save you a ton? Well, you're in the right place. In this video, we're diving deep into the Australian crypto tax rules for 2026. We'll break down how the ATO views your digital assets, what actually triggers a tax event, and how you can take advantage of that sweet 50% CGT discount. Plus, we'll cover the personal use exemption and the best ways to track your cost basis. Let's get started. Okay, so first things first, the Australian Taxation Office, or ATO, sees cryptocurrency as property, not foreign currency. This is super important because it means your crypto is a capital gains tax, or CGT asset. Every time you dispose of it, you could be looking at a CGT obligation. This includes selling crypto for Australian dollars, trading one token for another, gifting it, or even converting it to stablecoins. Now, for the good news, if you hold your crypto for more than 12 months, you might qualify for a 50% CGT discount, which literally halves your taxable gain. Remember, the Australian tax year runs from July 1st to June 30th, and returns are generally due by October 31st. So, what exactly counts as a CGT event in Australia? The ATO has a pretty broad definition of disposal. Basically, anytime you get rid of a crypto asset, it triggers a capital gain or loss calculation. This means selling crypto for fiat currency like Australian dollars, trading Bitcoin for Ethereum, using crypto to buy goods or services, unless the personal use exemption applies, which we'll get to, gifting crypto to someone, or even converting your crypto to a stablecoin like USDC. All of these actions are treated as disposals. But here's a relief. Just buying crypto with Australian dollars and holding it doesn't create a CGT event. And transferring crypto between your own wallets also doesn't trigger CGT, as long as you maintain ownership. Your capital gain or loss is simply the difference between the market value when you dispose of it and your original cost basis. Alright, let's talk about the 50% CGT discount. This is a huge benefit for long-term crypto holders in Australia. If you hold a crypto asset for more than 12 months before you dispose of it, only 50% of your net capital gain is included in your assessable income. For example, if you bought one Ethereum for $3,000 on January 15, 2025, and sold it for $5,000 on March 1, 2026, your capital gain is $2,000 because you held it for over 12 months. The discount applies, and only $1,000 is added to your assessable income. This discount is available to individuals and trusts, but not companies or super funds. The asset must be held for at least 12 months and 1 day, and it applies after you offset any capital losses. This creates a strong incentive to hold your crypto. Now let's get into cost basis methods, which can significantly impact your tax bill. The ATO wants you to track the cost basis of each crypto asset parcel individually. A parcel is basically each separate acquisition of crypto. When you dispose of crypto, you need to identify which specific parcel you're selling. Luckily, the ATO gives you flexibility here. You can use specific identification, where you choose exactly which coins to sell, similar to how the IRS does it. Or you can use FIFO first in, first out, meaning you sell your oldest crypto first. There's also LIFO last in, first out, selling your newest crypto first. And my personal favorite, HIFO highest in, first out, where you sell the crypto with the highest cost basis first to minimize your capital gains. The key is to apply your chosen method consistently and keep super accurate records. Your cost basis includes the purchase price, brokerage fees, exchange fees, and even gas fees for on-chain transactions. Here's a neat trick: the personal use asset exemption. This can make certain crypto disposals completely tax-free. If you acquire crypto primarily for personal use or consumption and not for making a profit, it might be exempt from CGT. This usually applies to small amounts of crypto used to buy personal items, like a coffee or a game. The ATO generally considers crypto a personal use asset if its cost is $10,000 or less. So if you use a small amount of Bitcoin to buy something for yourself, and the cost basis of that Bitcoin was under $10,000, you might not owe any CGT, but be careful. If you buy crypto with the intention of selling it later for a profit, it's generally not considered a personal use asset, even if you eventually use it for a personal purchase. This exemption is primarily for minor incidental transactions, not for your main investment portfolio. Navigating all these rules, especially tracking individual parcels and applying different cost basis methods, can be a headache. That's where tools like dTax come in. dTax can automatically import your transactions from over 20 exchanges and wallets, apply the correct Australian tax rules, and even compare different cost basis methods like FIFO and HIFO to show you which one saves you the most money. It's designed to simplify your crypto tax reporting and ensure you're compliant with ATO regulations. Check out getdtax.com. It's open source and free to start. So there you have it, a comprehensive look at Australian crypto taxes for 2026. Remember, understanding these rules, especially that 50% CGT discount and the personal use exemption, can make a huge difference to your tax bill. Always keep meticulous records of your transactions. If you found this video helpful, please give it a thumbs up, subscribe for more crypto tax insights, and share it with your fellow Aussie investors. Thanks for watching, and we'll see you in the next one.